Chapter 2: The Importance of Circular Flow in the Economy. Moving into this topic, we will discuss economic accounting, which differs from financial accounting but shares some common elements. Economic accounting, which is often referred to as national income accounting, is the core structure for macroeconomic measurement and equates two sides of a ledger: the aggregate income tally for the nation, with the aggregate expenditures tally. However, unlike financial accounting, it builds a time element to the accounting through economic theories, which add dynamic elements to the process. The history of national income accounting is tied to the National Bureau of Economic Research, or NBER, which was formed in 1920 under the direction of Columbia University professor Wesley Clair Mitchell. The NBER wrote of this history that, quote, Mitchell assembled a small group of researchers who were dedicated to improving economic measurement. Mitchell recruited one of his recently graduated doctoral students, Simon Kuznets, to join the NBER staff. Kuznets quickly became an expert on economic measurement. In the early 1930s, in response to a request from the U.S. Department of Commerce for support in developing measures of aggregate economic activity, he led an NBER research project that became the foundation of the U.S. national income accounts. This was one of the contributions for which Kuznets would be awarded the Nobel Prize in Economic Sciences in 1971. Unquote. In this lecture, you will learn. Unlike financial accounting, those two sides of the national income ledger have a feedback relationship over time, which is portrayed as a circular flow. The national income and product ledger has one side for expenditures and another side for income. The expenditure side represents gross domestic product. The income side represents gross domestic income. After all transactions in the period are completed, gross domestic product will equal gross domestic income. The expenditure multiplier is a feedback loop between the expenditure and income sides of the ledger, and some national income accounting relationships have significant implications for the economy. So, let's begin with the discussion about the circular flow process. What is circular flow in the economy? The circular flow chart is portrayed with various levels of embellishment. However, maybe the simplest form of this relationship is used by the U.S. Commerce Department's Bureau of Economic Analysis, BEA, and shown here, to relate the expenditure and income sides of the economy. The BEA's depiction of the circular flow in the economy links individuals with businesses. Businesses pay wages for the labor of individuals, which is an input into their production process for producing goods and services, which, in turn, becomes the expenditures of individuals or households for those goods and services. Why is circular flow useful? The reason the BEA uses this circular flow chart is to introduce how the national income and product accounts, the GDP report or NIPA, are constructed in a similar manner to financial accounting's use of a T account for double-entry bookkeeping. For the entire economy, the double-entry bookkeeping concept is that the sum of all expenditures will equal the sum of all income. How are expenditures and income measured? Expenditures are represented by gross domestic product, GDP. Incomes are represented by gross domestic income, GDI. We will discuss these terms in further detail shortly. Why are expenditures and income equal? Probably the clearest discussion of this relationship was presented by the U.S. Bureau of Economic Analysis, which produces the GDP and GDI statistics. The BEA describes the GDP and GDI as follows. Quote, Gross domestic product, GDP, and gross domestic income, GDI, are measures of the same concept of total activity in the U.S. economy. GDP measures activity as the sum of all final expenditures in the economy. It is detailed on the product side of the domestic income and product account. GDI measures activity as the sum of all incomes generated in production. It is detailed on the income side of the account. By design, The flows of final expenditures and incomes generated are equal. Thus, GDP and GDI give the same measure of economic activity, but in practice, they differ because each is estimated from largely different source data. The difference between GDP and GDI is allocated to the income side of the domestic income and product account and is known as the statistical discrepancy. Unquote. Let's look at these actual reported data by the BEA for GDP and GDI for years 2020 and 2021. The BEA's Table 1.1.5 shows GDP in billions of dollars. Table 1.10 shows GDI also in billions of dollars. Although the data are close to each other, they are not exact due to the different sources used to compile the statistics, which have measurement errors. However, the income side of the ledger represents more complex measurement, and for that reason the BEA assumes that income side should include the discrepancy to equate GDP and GDI. This graphic shows the relationship between GDP and GDI. This graphic shows the statistical discrepancy between GDP and GDI over time. This graphic shows the growth rate differences between the annual percentage change in GDP and GDI. Up until now, we have only discussed the aggregate measures of GDP and GDI. But what are the components of GDP? GDP is the sum of expenditures on consumption, investment, government spending, and net exports, that is, exports minus imports. The table shows the annual levels of each component. Note that personal consumption expenditures, that is, what you and I and your family spend, represents nearly 70% of the total GDP. Investment, or, technically what is called gross private domestic investment, represents another 18% of the total. Investment includes both business and residential investment, new houses or apartments, plus inventories. Government spending is also about the same size as investment, though investment will vary depending on the health of the economy. Finally, note that net exports is the difference between exports and imports. The health of the world economy and strength of the US dollar versus foreign currencies are key factors that will determine the strength of exports and imports. More will be said about that later and other drivers of the expenditures. What are the components of GDI? The measurement of aggregate income is not as simple as GDP. In essence, though, GDI represents the sum of all payments to factors of production, labor, capital, etc. These payments encompass the compensation of employees, proprietors' income, corporate profits, rental income, and net interest. Notice that employee compensation, that is, wages and benefits, represents slightly more than half of all GDI. So far, we have been discussing GDP and GDI from the measurement side as compiled by the U.S. Commerce Department's Bureau of Economic Analysis. The next question we need to explore is how do those concepts relate to more theoretical concepts from macroeconomics of aggregate demand and aggregate supply? So, let's now discuss, how do aggregate demand and aggregate supply relate to GDP and GDI? Up until now, we have only referred to what is known as current dollar GDP and GDI. That means that the figures represent what was actually tallied. But those current dollar figures have a parallel set of measures that are adjusted to remove the effect of inflation. Those data are commonly called real or inflation-adjusted GDP and GDI. Although the base year for adjustment of the current dollar figures for inflation is arbitrary, the BEA sets its inflation-adjusted data in 2012 dollars. That simply means that the price indexes used to adjust the current dollar figures of GDP and GDI are based in 2012. We will revisit these concepts further later, but for now it is sufficient to recognize that there are inflation-adjusted counterparts of GDP and GDI to the current dollar figures that we have been discussing up until now. With that said, in the aggregate demand and aggregate supply model framework, aggregate demand equals real or inflation-adjusted GDP as measured in constant 2012 dollars for the U.S. economy. Short-run aggregate supply equals real or inflation-adjusted GDI also as measured in constant 2012 dollars for the U.S. economy. Take a moment to focus on the table that shows what equals what in equilibrium. There are important relationships to actual data with theoretical concepts from macroeconomics. As noted earlier, macroeconomic theories build upon the economic dynamic. However, the national income account system is simply a snapshot of spending and income for a period in time. However, remember the early graphic of the circular flow diagram that showed the feedback between income and expenditures for the businesses and households. This feedback is the basis of the economic concept of the expenditure multiplier. How does the circular flow relate to the expenditure multiplier? The circular flow chart also is the conceptual foundation for the expenditure multiplier. The expenditure multiplier measures some multiple of the total new spending injection over time. To understand this concept, for every increase, or decrease, in expenditures in the economy, there is an increase, or decrease, in income in the economy, as the circular flow chart demonstrates. This represents the direct or first round effect. However, that increase, or decrease, in the incremental income today will create an incremental increase, or decrease, in expenditures tomorrow, the second round effect. This initial incremental increase, or decrease, will continue to ripple because of the circular flow in the economy between expenditures and income. However, for each new round the amount of the change, positive or negative, becomes increasingly smaller and the ripple effect will eventually fade out, much as tossing a stone into a lake and watching the water ripple get increasingly less pronounced in the outer rings. Another question that is relevant from both the accounting and ultimately the theoretical side is, why are we interested in NIPA components that add to or subtract from GDP? The circular flow chart also gives rise to the expenditure injections and leakages concept for the economy. This concept is sometimes referred to as the magic equation, and is based on national income and product accounting. In essence, the basic expenditure income circular flow can be disaggregated, such that aggregate expenditure components can be designated as an injection into GDP or a leakage from GDP. Injections add to the GDP tally and its feedback loop effect. Leakages subtract from the GDP tally and, in turn, its feedback loop impact. Which expenditure components add to and subtract from GDP? The main additive components to GDP are investment, government spending, and exports. These factors are called injections to GDP. The main subtractive components from GDP are savings, taxes, and imports. These factors are called leakages from GDP. So, for example, if households increase their savings, that means they are consuming a smaller share of their income, which will depress GDP. Similarly, for higher taxes, that takes a larger share of business or personal income, which in turn reduces investment or consumption. On the other hand, lower taxes may either be saved or spent, so that depends on what is done with the lower taxes. What are the implications from balancing injections and leakages in GDP? When the GDP subtractive or leakage factors of savings, taxes, and imports are greater than the sum of investment, government spending, and exports, injection into GDP, then there is downward pressure on real GDP. However, if the sum of savings, taxes, and imports, leakage from GDP, is less than the sum of investment, government spending, and exports, injection into GDP, then there is upward pressure on real GDP. Of course, when the injections fully offset the leakages, then there is a neutral impact on real GDP. The concept of injections and leakages is only focused on GDP and not GDI, largely because it is clearly defined components that affect overall expenditures in the economy. How is the injections-leakages identity related to the supply and demand for financial capital? Now that you are aware of the injections-leakages relationship, through other national income account tables or relationships, it is possible to relate the expenditures to the demand for financial capital. By financial capital, it is meant the availability of funds, that is, borrowing, from domestic and foreign sources. Rearranging the injections-leakages identity, it can be shown that the supply of financial capital will equal the demand for financial capital, when savings plus imports minus exports equals investment plus government expenditures minus taxes. This national income identity leads to the conclusion that if government spending is greater than taxes, then the government would be a demander of financial capital. If, however, taxes are greater than government spending, that is, there is a government surplus, then the government would be a supplier of financial capital. Clearly, the U.S. government is a running budget deficits, and hence is a demander of financial capital. Finally, this leads to another observation. How does the injections-leakages identity inform us about the twin deficits, that is, the federal budget deficit and the international trade deficit? Rearranging the injections-leakages identity leads to the conclusion, as shown here, that when government spending is larger than taxes, then either the international trade balance and/or the savings investment balance must compensate for that situation. This means, if the U.S. budget deficit grows, then the U.S. international trade deficit will as well, and vice versa. Finally, consider the issues to think about.